Hey Gowinvest family, it's Sobi Kenobi here today, and I know you guys are all wondering how the account's doing. It took a small hiatus because I was moving, but I do want to show you guys what the account's doing right now. So currently, I am up, let's see, I'm up $309 from like $500. You're wondering, how's that even possible? And I will tell you. And that is in today's lesson, lesson number 8 of Go Invest 101 Psychological Trading. Um, and we're going to cue the intro. Okay, guys, so every trader has a drink of choice, whether it be tea or coffee. My drink of choice here is orange juice. Gives you all the energy you need to start a day of nice trading. This really kicks you into high gear. All right, so now we're here. Lesson number 8. Psychological trading. COLPHPSYHCO, logical trading. Okay. So psychological trading. What does this entail? So the idea is that imagine you think that buyers here buy up the price. They cause the price to go up. A seller, because they are moving it down, they're selling, they're going to move it downwards because people who buy and people who sell basically move the price up and down. But that is antithetical to their motive. A buyer, even though he'll cause the price to move up, really wants to get it for the lowest price. Wants it for lowest price. And the person who's selling it really wants to get the most. But what really causes people to buy and sell a stock, because a stock has no intrinsic value. I mean, it does have some intrinsic value. It does denote that you are part owner of a company, but really you can't do anything with a stock. There's no utility, really, not intrinsic value. We need utility. Is there anything you can do with a stock? Nope. You can only buy it or sell it. And there's an idea of seeing the stock in real time gets people very emotional. So say I bought it in here. Now it's going up in value. I'm happy. I'm happy as long as it goes up in value. Once it goes down in value, I start to get scared. Should I sell it? Should I pick it back up on a dip? You know, what's going on? People start selling. So there's a huge herd mentality here. People want to buy when it's going up, and people want to sell when it's going down. Now, Warren Buffett said, I think it's Warren Buffett or somebody else, I don't know. But it's basically be greedy when everyone is fearful. I'll just do the shorthand. And be fearful when others are greedy. Simple, like just a juxtaposition of the first statement makes it sound very wise, you know, but it's really not wise at all. So we're gonna go into why that is. Let's say you have a political campaign. You got people here who are Democrats, and you have people here who are Republicans, and then you have the independents are people who will choose one side or the other depending on how they're feeling. All the campaigns, they already know that this is a constant. They know that these are constants. What really has the effect is these people in the middle. The people deciding, so there are bulls in the market who think a stock should be worth way more than it is. Okay? They really feel like this stock should be trading a lot higher than it is right now. And those are one groups. I'm not saying that they're particularly Republican or Democratic, but they really believe that the stock should have a higher value than where it is. There's also the bear, which thinks the stock should be really a lot lower than where it's trading at. But the people who move it is not it's not one of these two groups. It's not the bear or the bull. It's the people. So let's say the bull's already bought some stock. There's some, and then the bears hold some short positions. But they already did that. What really causes the motion up and down of a stock is the people who think that it has a value right around where it's trading. So if you have 100% conviction one way or another, you're really not influencing the value of the stock. The only people who influence the value of the stock are active traders. I want to try an experiment with you guys. There's this Flash game. I'm wondering if even Flash is available now, but let's try Toss the Turtle. Alright, so we're going to play it. It's a simple game. Really, all you do is you have to keep a turtle up in the air. I'm going to click play. We're going to play. Okay, let's play. So the idea here is that you shoot him once, and then you can hit him again, and hit him again. Okay, the idea is to keep him up for as long as you possibly can. Now I'm going to close this because it's getting annoying. But the idea, whenever you shoot, let's say you shoot, basically you're blowing your load. You are using all your money. So the idea is that you can buy. So if you buy into a movement, let's say you keep on buying into the movement. Yes, it does jump it a little bit. It gives it a little bit of momentum. But a lot of people are already buying, so you have very little effect. Al. So if you wanted to basically be this independent guy and move the markets, what you want to do is buy at a period of rebound. Rebound up or rebound down. When we see a turn of MACD, if you basically buy at these rebound points, either you short at this rebound point or you buy in on this rebound point, your vote or your bid will have the most impact. So even though let's go back here, even though the buyer wants to buy it for the lowest price, he also wants it to have a higher value than when he bought it at. So by buying at these particular times, you know you get it for both the lowest price. You get it for both the lowest price and you have highest momentum. So you have the lowest price and you give it the highest momentum to rebound. Now, there are disingenuous actors. So assume that we have a person who wants to sell. A person who wants to sell is driving down the price. So he doesn't want to sell at the highest price because it's actually in his best interest to get it at a higher price. Because if it was at a higher price, he can sell it for a higher price and then he can make more profit. However, part of it is fear. So he does fear with the rest of the market when the stock is going down that he should sell. And that's one type of trader. But the other type of shorter or seller is disingenuous. So it is a short, or a shorter is basically borrowing shares. He borrows shares and he sells them. So he borrows shares. And basically he sells them right away and basically he'll buy it on an uptick. This borrowing shares regards as, he has to pay interest. Pay interest if he doesn't close within a period of time. So if he doesn't close within, let's say, one trading day, he has to pay some interest on the shares that he borrowed. So somebody will borrow shares. They'll expect the price to go down, but if they don't buy it back to give back to the original owner, what they are doing is they are shorting it. So they are selling for the price, to go down. That is a disingenuous selling. But what they realize here, and this is the thing, there's a hedge fund. So it's almost like a self-fulfilling prophecy. A person who shorts causes the price to go down, causing the fear for everyone else to short as well. So it's a cycle of fear. They realized that every stock has a huge rise and then the decline is almost guaranteed. All right, everything has a rise, but some things have less rise than others. But once something has passed its prime, usually it dies. And that's the cycle with everything in life. There's a lot of companies back in the days who were like name household companies, like say Westinghouse or something like that. Nowadays, there might be a microwave brand or something far, underneath where it was, but it's definitely on a downtrend. So they realize that if they can get into this idea, they can take money that was originally supposed to go for people who are betting up a stock. They wanted to invest. It takes money away from them because people are buying borrowed shares, and then they'll just have to buy it back at the low end. So the longer they do this, they win. And majority of time, they could have done this completely without any problem. But there is the idea now that's kind of crazy. It's called HODLing. What is HODLing? HODLing is really just a replace of holding, but HODL stands for hold on for dear life. And why would people hold on for dear life? So this idea is that you don't hold your money in a bank account. All right, screw the banks. We're not holding in a bank account. We have so much conviction on a stock or on a crypto that we will, when we get new money, we buy. Because no matter where we're buying, it's a good time to buy because it'll go up and up and up. So you always dollar cost average down. Down. And really dollar cost averaging is, you say you buy it at, let me open up a new thing. So say you buy it at like 100. It goes down to 80. Now you buy it again at 80. So your average here is 90. Then when it goes up to 95, you're in $5 of profit per share. So that's called dollar cost averaging. Gee, but honestly, this is what translates over, like, the bigger brother to dollar cost averaging is HODLing. And it's just a crazy mentality, but what that does here is it puts an enormous buying pressure right at the dip. People put in more money, almost like a cultish religion. And they are just buying to no end. And what that does is those short people have to still pay interest. And they are now going to be in loss. They have to borrow it back, but they have to borrow it back at the higher price. So when they close their shorts, closing shorts cause a huge influx. So again, let's go back to my account. So I'm going to disconnect the tablet and explain my account strategy. Let's put this in. Let's open up the visor. It's as small as can be. I don't know why. Let's view the device. Huh. Okay, so here's the device. All right, so imagine this. Let's go back to the original stock. We are now currently only up 259, not our original 300 because I'm in an options contract. And here was the idea. Basically yesterday, and I do want to get my history on this so that you can see what I did. I'm not sure how I get my trade history because it's just showing me my open positions and it won't show me what I did yesterday. But basically what happened yesterday was this on CCIV. Here's a stock. Okay, so this is what happened yesterday. I bought in here on the confirmation of, like, you can't see it right now, but basically it was confirming the MACD right here. So I bought shares. And then it went up for a little bit. It held there for a while, but then it went down. And not only did it go down, it went down again. And at this point, I decided, hey, I'm going to buy in some call options. I'm going to sell my shares and buy in call options because I already got it on a confirmation. But the thing is that why did it die some more? I checked out CCIV is going to buy out is gonna merge with Lucid, which is this Tesla competitor, and the thesis for it was definitely worth about $30. Price analyst wise, ZipTrader even talked about it. If you follow ZipTrader's videos, and then you see here that it decreased some more. So I'm thinking this is just a downturn in the market or something like this, but this is such a big deal that I cannot pass off on it. So I went in, I sold my shares, and I got into calls. Options contracts are way more fearful, way more greedy than any stock positions could be. So when you see this go to an substantiated low. So some stocks can fall, but they fall on no news. Why did they fall? The news story for this stock, for this company, is generally good. Maybe it just fell with a downturn of the market. Maybe it just flash crashed. Somebody decided to sell a whole bunch of shares, just wanted out. But so I bought an options contract at this low. Then it would go up and I would be making money, maybe about 50 something bucks, which to me is great gain. Any gain is good gain, especially on a $500 account. But then it fell down towards the end of day and I was down $79 or so. And even this morning, it went down a crazy ton. I think, down like $150 on the low, or even $160 on the low. But again, it's unsubstantiated. So if I had more money, if I could do a Fibonacci double down, I would buy in again here, and I would buy in again maybe, or I would really buy again here. I think this is just pre-market, post-market from yesterday. So it closed out over here. It did a post-market run. This morning it was down like 130, and then it just started running from there. And I got the 27 calls. Again, the calls were close to in the money. And we'll talk about that when we do our options contract. But basically, currently up $274. My thesis was this would break up 27.25, maybe even 27.50 by end of week. So I can just hold in gains for a little while this is still the narrative. And then if it completely inverses my narrative, if I'm above my strike, it will always be in profit. That is intrinsic value. And I can get out at maybe not exactly $300 profit, but somewhat around there in the case that it goes bad. But the other idea here is that it could continue running. Say if I sold this right now, I can lock in $300 of profit. And $300 of profit on a $500 stock is worth locking in. And I'm absolutely for that, but for my thesis, it still hasn't satisfied my thesis yet. So until I am satisfied and I have a validation, that's the only time that I'm selling out. And of course I have those multiple exit strategies. So that's my idea on this, and I hope you guys learned something about trading. It's not about the shares that you hold. You can be one of these guys that are bull and you've bought in some stock, but you've really moved the needle very little. You've made your decision one time, it pushed it as little as it did on a specific buy path. And now we have the best time to really buy is on a rebound, and you have to not be stupid and sell out in some profit. So I mean, ideally, if I see this, somewhat turning against me on this chart where it follows below the Bollinger Band, I'm selling out, I'm locking in profit, and that's how you play the psychological game, psychological trading game. All right, hope you liked it, and have a nice day.